Very good afternoon, everyone. Nice to see you again. Um, so, if we talk about the foreign exchange risk, we know that almost every organization, every business will deal with foreign exchange or currency risk, either directly or indirectly, right? Some organizations, especially the bigger ones, will have to deal with the foreign exchange risk directly uh, in the forms of export and import, some maybe joint ventures with international organizations or some business partners. On the other hand, some organizations that seem to be purely domestic, actually they also deal with the foreign exchange risk because they need to adjust to input prices and also uh, the maybe manufacturing costs that they have to bear because of uh, the again the input prices or some products that they have to use in as the inputs. Well, uh, those products or those inputs come from overseas, or you just simply have to adjust to the currency situation because of the competition and because of the business nature. So I can give you an example. Maybe the uh, a domestic bicycle producer, right? It still has to fight, or it still has to adjust to the foreign exchange situation. Although, let's say even all of the inputs and uh, labor and uh, most of the costs are actually domestic, right? Because it has to compete with some bicycles from other countries, right? The imported ones and so forth. So we can conclude that almost every organization, almost every business has to measure and manage the foreign exchange risk. So that's our discussion point today, and let's go straight into our materials. Okay, you see the background here: globalization in financial markets, in product markets, and all sort of markets actually uh, have increased the necessity to measure and manage the foreign exchange risk or currency risk. Right? So, right, especially in the industry of finance, banking, right? We call it financial institutions. So definitely we have a lot of assets and liabilities denominated in foreign currencies, right? So this has been like again the necessity or the required practice for the financial institutions, right? To measure the manage the foreign exchange or currency risk. And you see here an example of a lot of quotations, a lot of quotes here. Uh, Countries with their currencies, right, from Argentina to uh, uh, Uni Arab Emirates, right, from peso to dirham, and so many currencies in the world. Um, so they have their own uh, monetary systems, right? And of course how they manage they manage their currencies. So that's out of the scope of this session about uh, the monetary policy of every country, and then how they manage their currency system and so forth. So for today's session, we're going to see uh, only how to use like derivative securities, hedging mechanisms to help manage the foreign exchange or currency risk. Okay, so foreign exchange rate. There are a lot of um, like practices, dynamics, and customs in the world of foreign exchange. We study this a lot in the multinational finance or international finance or some courses like that. But we'll see some important concepts right, from the multinational financial management. So we have types of quotes here. We have direct quotation and indirect quotation. So direct quotation means that you mention your home currency in front, while the foreign counterpart at the back. So let me maybe write it down in the notes. All right, so for direct quotation or direct quote, so you mention your home currency in front, or we call it reference currency. So you quote it home per foreign, home per foreign currency, right? Okay, so we call it direct quotation. So the currency that you mentioned in front is called reference currency. Reference currency, while the one at the back is called the anchor currency. Okay, so let me give you an example. If you mention something like uh, anything like maybe 110 per euro, so this is a direct quotation for the United States. Okay, so direct quotation for the United States because you mentioned your home currency in front, right, and the foreign currency at the back. Okay, so on the other hand, the other quotation would be indirect quotation. Okay, indirect quotation. So this would be the opposite, where you mention the foreign currency first and your home currency at the back. Okay, so we give you an example. Uh, if you are saying uh, maybe pound per dollar, so this would be indirect quotation for the United States, right? But this would be a direct quotation for the United Kingdom. Okay, and for this one, this would be indirect quotation for euro, but this is a direct quotation for the United States. Okay, so just remember, for direct quotation, you mention your home currency in front, and that's usually the norm in multinational finance or in currency quotation. The direct quotation is more common, except for certain currencies that have like high values. Usually, they will be mentioned or they will be quoted as indirect quotation. Okay. So we see an example from here. This is like 89 cents per Canadian dollar. So this would be a direct quotation for the United States, but indirect quotation for Canada. Right. On the other hand, this one, this second example would be uh, direct quotation for Canada, but indirect quotation for the United States. Okay, so we have the term spot and forward. Uh, I explained this a lot in another video named Derivatives, maybe part one, I think. A spot and forward. So we can see this is a spot and forward. Spot means you make a deal right now, and you also execute the deal right now. So the spot, I think the limit for spot would be T plus 2 or T plus 3. So we still call this a spot transaction or spot market. So you make the deal right now, and you also execute the deal about right now, or maximum T plus 2. On the other hand, forward transaction would mean making a deal right now, but the execution will happen sometime in the future. So sometime in the future could mean like 1 week from now, or even maybe 5 days from now, or 6 months from now, 2 years from now, 5 years from now, and so forth. Right. So the deal is made right now, but the execution uh, will take place sometime in the future. Okay, so you see here net exposure. Your net exposure is actually the difference between your uh, assets and liabilities in foreign currencies, and also difference between your long and short position. Right, so uh, that's why actually the measurement and also the management of uh, currency risk in this context would be better done in the corporate aggregate level, because actually uh, you might be able to enjoy the that on balance sheet hedging or natural hedging, we call it, right? So I would like you to see this possible situation. If you have a lot of subsidiaries, right? You have a lot of subsidiaries, so they will have let's say you have at least maybe three, for example, three subsidiaries: subsidiary A, subsidiary B, and subsidiary C. Okay, so each of them will have uh, assets and liabilities in foreign currencies, right? So if you aggregate uh, all of the exposure at the corporate level or at the aggregate level, actually you might be able to enjoy again the natural hedging. For example, let's say the subsidiary A, they're having a short position in, let's say, euro. Right? Net short position means that they have more liabilities than assets in euro. Right? And you find out that actually this for a subsidiary C, you have a net long position in euro. Okay, so net long position means that subsidiary C has more assets than liabilities in euro. And let's assume that the amount is 10 million euros here, and the net long position here is, let's say, 7 million. So you see, so you actually you get the natural hedging, right? If you combine, this is a small example, right? Even with a small example, you can imagine if you combine at the aggregate level, your net exposure for euro is only 3 million, right? Because you have uh, net short position for subsidiary A of 10 million, and a net long position for subsidiary C at 7 million. So you have remaining 3 million of short position in euro. So you see, you could cancel out many of the currencies, right, in this context, if you do it at the aggregate level. So it's very important to estimate the net exposure rather than, uh, of course, it's not wrong, but rather than letting each of your subsidiary to manage its own currency risk. It would be more costly, right, and uh, less coordinated, less aggregated, right? So it's more expensive or more costly. Okay, so we'll see an example here why this is quite important part of your business, right, in modern times. Again, I talked in another video that maybe 50 years ago, 60 years ago, if you suffered a loss because of currency risk or any other types of risk, you could use an alibi, a reason that it was like beyond your control. You have served your customers well. You have done your best to manage the business, right? To satisfy your customers, to offer excellent products, right? To motivate your employees, and you try to improve efficiency and profitability of the firm. But suddenly you suffered a huge amount of loss just because of the currency risk. So 50 or 60 years ago, you could simply say or use the reason that it was beyond your control. But now, if you are using that reason, you'll still be fired because you have not done enough, right? You don't do the proper hedging mechanism, leading to a huge amount of loss engendered by the foreign exchange risk. Okay, so let's see an example here. On May 15, the exchange rate was 15528. So usually we use four decimals for this kind of multinational calculation uh, per British pound, right? 15528. So let's jot down here. So May 15 is 15528 per pound. Okay, and it's now June 15. So it's about a month later, and a US made brick enclave costs 55,000. So you have a car that costs $55,000. Okay, so 55,000, right? So see the story. Let's continue with the story. Okay, so on June 15, the exchange rate has been 15602. 5602. So what's happening for the last 1 month? You see the number in the reference currency, right? The amount in the reference currency shows an increase. It means that the anchor currency has appreciated, right? So we have I think two common terminologies here. Appreciation. Appreciation means an increase, right? And we have depreciation means a decrease if it happens naturally. If this happens because of government policy, government deliberate policy, then this would be called revaluation, and the other one would be devaluation. So revaluation and devaluation are like deliberate decisions by a government, right? Whereas appreciation and depreciation happen naturally because of the demand and supply. So these are the common terminologies for the multinational international finance field. Okay, so what is happening now? On May 15, to get £1, you have to sacrifice 15528 US dollars. On June 15, to get £1, you have to sacrifice or you have to exchange it with 15602. So for the last 1 month, pound has appreciated, right? So think about it again, right? On May 15, to get £1, you need to hand in 15528, whereas on June 15, to get £1, you have to hand in 15602. So pound has become more expensive, right? More pricey. That's why we say that pound has appreciated. Pound has increased in value. Or on the other In other words, dollar has depreciated. Okay, so the information tells us that the price of Buick has been 50,000 throughout. Okay, throughout the month. So actually, the price of the Buick doesn't increase nor decrease, right? It remains at 55,000. But uh, when we translate now the value of the Buick in UK pound, it shows the difference meaning, right, after 1 month. So what is the beginning value of the Buick in UK pound in May, on May 15th? So see here, this one. So 155,28 per pound, and the price of the Buick was $55,000. Look carefully, right? Because the currency mentioned is the same in front, so you divide, right? If they're the same, if they're the same at the back, then you multiply. So they are the same in front, right? A dollar in front, and this is US dollar. So you divide. Right? So how much is it? 55,000 divided by divided by 155.28 per pound. Okay, so how much is it in pound? The 35,000, 35,419 and 89 cents. Okay, so this was the uh, conversion into UK pound in May, or to be precise, on May 15th, right? What about on June 15th? The price of the brick remains at 55,000, but now this is the spot rate on June 15th, right? So again, you see the currencies are the same in front, right? See the dollar per pound, and we are looking at like $55,000. So they are in the same in front. So again, you divide, right? You divide. So 55,000 divided by 15602 per pound. Right. So you get, let's calculate here. Now 35,000, 251.89 cents. Wow, this is quite good news for the British people. So the cost of Buick in US dollar remains the same, but when we convert its value into UK pound, you see a decrease, right? Because now pound has become more valuable, right? Pound has increased in value, right? See, from 155.28 per pound, it has increased to 156.02 per pound, right? So uh, pound UK pound has appreciated in value, right? Relative to US dollar. So you see the cost of Buick actually decreased in UK pound, right? From 35,419 to 35,251. Okay, so see an example here. So we need less UK pound, right? British pound to buy the Buick on June 15th because of the appreciation of the UK pound. Okay, we see exchange rate movements, right? Historically, from 2003 to 15, right? And you can continue the graph. It's quite, of course, volatile from time to time, especially when there is like financial crisis, in a certain region, then you will see like a skyrocketing or a plunge in certain currencies, right? That's unavoidable because currencies are just following the demand and supply mechanism. And so uh, if a certain currency is highly demanded, then the currency will appreciate. And on the other hand, right, if uh, there is a capital outflow, a huge capital outflow, then the currency is less demanded, while the supply may remain the same. So the value of that currency will decrease or will depreciate. Okay, so we may have positions in spot and forward markets. We talked about this, right? Spot means again the deal is made now and execution is also happening now. On the other hand, for the forward market, we make the deal right now, but uh, you execute the deal sometime in the future. Right? So financial holding companies have even greater ability to reduce their net exposure. This is true. We saw it before. Right? Actually, uh, if you aggregate your foreign exchange risk at the corporate level, you can enjoy some form of natural hedging because some of your subsidiaries might have a net long position in a certain currency while the others are having a net short position. So they have like natural hedging. And of course, the remaining risk has to be hedged using the derivative products, right? Such as forward, futures, options, and so forth. But at least you can get some amount of natural hedging from the aggregation. Okay, so dollar loss or gain in currency, this would be the net exposure multiplied by the shock. Right? The shock means could be appreciation or depreciation of that currency. Like we just saw in a small example about the Buick car. I will see some more examples right, throughout our discussion here. And historically, we are seeing here uh, assets and liabilities from foreigners, right? From foreigners reported by banks in the US. So liabilities to and assets from foreigners reported by banks in the US. And we see an increasing amount, right? You see an increasing trend, uh, maybe except in during this period, right? The banking crisis in the US from 2008 to 2010, I think during that period, we are seeing a slowing down of the foreign assets and liabilities. But afterward, we are seeing again a skyrocketing numbers again, both for assets and liabilities. And see, forex trading, foreign exchange trading, turnover is over $5 trillion per day. This is the largest market of any financial products or financial markets that exist, right? If you see even the market capital, also the trading volume on the New York Stock Exchange is probably today around 100 billion or a little bit more. Only 100 billion a day. That's big enough, right? Maybe already the biggest equity market in the world. But foreign exchange markets in the world uh, has a turnover of five more than $5 trillion a day. This is like a huge big cake, right? A wonderful cake for the market players. Right? So several years ago, I had a client right, that offered this kind of trading and also simulation, right? And so I got a chance to ask the owner, right, uh, whether their big data analytics and also artificial intelligence could someday compete with Bloomberg or yeah, any names, Vanguard or Thomson Reuters or something like that. And this guy replied that never, never, they could never compete with like big names such as Bloomberg and something like that. But you're saying that the cake was big. So the cake was very attractive. It was big. So even small players could actually get some chunks of the cake. So it wouldn't be any problem, right? Of course, competition is getting stiffer from year to year, but still, because the cake is big, so even a relatively small player, uh, consultant, trader, or something like that, still enjoys a good amount of fees and profit or something like that, right? Because again, the transaction volume is super big, right? More than $5 trillion a day. So I would suggest that you think about it, right? If you're still studying at university, at an undergraduate program, you might want to, finish your degree and then go to work at the forex market, right? Foreign exchange market, and maybe you work hard for 10 years, and maybe you could retire after 10 years. You get a lot of money and start doing something slower after 10 years. But maybe for the first 10 years upon graduation, you have the energy to earn as much money as possible from this market. Okay, so electronic trading now constitutes more than 70%, of course, right? It will increase maybe more than 90% in the next decade. Okay, so US bank positions in foreign currencies and foreign assets and liabilities. You see, here's the long position, right? Buying position, and short position or the selling position. So you see the net position. So this is actually the most important figure rather than looking at each item. Is better to see the whole net position, because this will tell you that the net exposure for every currency in a bank or in the whole system of banking in a country. So again, net position is the difference between assets and liabilities, and also between long and short position. Okay, so see our exposure, calculation of exposure. One example here, June 14. Net exposure is, this is by a US bank, right? £2.5 million. This is the exposure on June 14th, 2015. Um, and the exchange rate was 15828, similar to our previous example, right? So on June 15, the exchange rate has become 156.02. Uh, so what is happening now? You have net exposure 2.5 million. Okay, so the same here, same currency quotes 15528 to 156.02. So once again, for the last 1 month, UK pound has appreciated against the US dollar. As you see on May 15, to get £1, you have to pay 150, 158.28. Whereas on June 15, to get £1, you have to hand in 156.02. So pound has become more expensive, right? Has appreciated against the US dollar. So if you have net position of positive 2.5 million, now you can imagine, right? 2.5 million. Are you happy as a US corporation or US bank? Certainly not, right? Certainly not, because you know that for the last 1 month, pound has appreciated in value against the US dollar. So pound has become more expensive. So uh, net exposure, right? So if you have an exposure of 2.5 million, okay, so let's say this is your liability, well knowing that the pound has appreciated in value, then actually you will lose something, right? Right. So your exposure remains at 2.5 million after 1 month, but the value of the pound has changed. Right? So let's calculate where's the beginning value of this exposure in US dollar, and look at this. They are the same at the back. You see, this is dollar per pound, and the value that we know is in pound. So there's the same at the back, right? You see, the pound is at the back, and the value that we know is pound. So we multiply them, right? So we multiply 2.5 million by 15528, and you get 3,882,000. Okay, so what happened 1 month later? Again, your exposure remains at 2.5 million. Let's say you have a maybe total liabilities in pound of 2.5 million. Now, how much is it in US dollar? 1 month later, again, they're the same at the back. You see here the quote is dollar per pound, and you know the value of pound, so you multiply them, right? So 2.5 million multiplied by 15602, you get 3,900,500. Wow, this is something again. Uh, you could have said something beyond your control maybe 50 years ago, uh, because this was not your mistake. You had served your customers, you had produced like good offerings, good products, right, for your customers and so forth. But you see, there's a loss involved here about some 18,000 or something, right? So yeah, about yeah, 18,000, about $20,000. You simply lose the money just because of the change in the exchange rate. So not because of your bad operational performance, actually. But again, now you can't use that reason, because if you say this is beyond your control, you'll still be fired in these modern times because you don't do enough. Okay, so top currency traders, you can see some big names there. Citigroup, Deutsche Bank, Barclays, UBS, HSBC, and so forth. So this keep changing, and I think the Chinese banks are getting also a lot of uh, currency positions, right, in the last decade. This is in the U.S. alone. Foreign exchange trading income of major U.S. banks in from 95 to 2015. See trading income, right? And so you're seeing actually not necessarily an increasing trend. It increased, but then steadily decreased from 2009 and then 2011, even 2014, 2015. So it has become, of course, 2015 is not the full year because of the making of the statistics at that time. So it would be maybe around the same or a bit higher, but we're seeing that it's after the banking crisis, the trading income has been steady, so it has not increased nor decreased significantly. Okay, so what are we doing with the currency transaction or trading activities? We have four possibilities, right? So the first and foremost possibility is complete international transactions. So you just buy and sell, right? So you need foreign currencies for export and import international transactions. So this is natural. For example, if I again I if I make bicycles in my home country, so I will need the uh, some materials like carbon fiber, some high grade aluminum or something like that. Or maybe I need to import, so I have to pay with the with US dollar or with new Taiwanese dollar or something like that, right? Our second possibility is like financial investments, real and financial investments. So you're doing investments in foreign countries. Maybe you're from Singapore, you're going to Malaysia or Indonesia to invest, right? So you need the currencies, right? The local currencies to invest. So real and financial investments are both, right? Uh, and then the third one, this is what we are going to talk about a bit more today, the hedging activities. So again, I have some videos on derivative products and also the hedging mechanisms. Hedging activities are just the norm today, right? Something that you have to do to measure and manage your risk, including the foreign exchange risk. And number four, this is interesting one, speculation. Speculation. So some people just speculate using the like foreign exchange market with expectation of getting quick and easy money. Well, of course, it's not necessarily easy, right? Because when you speculate, you always find a 50-50 position, or maybe the best position that you could get maybe is 20, 75-25. Okay, so uh, if you think about it, even if you have the possibility of getting it right at 75%, you still have the possibility of guessing it wrong of 25%. And that's super big, right? 25% is really big. And normally we have the 50-50 situation. So speculation looks easy. This could create a myopic behavior, right? And uh, in my discussion in the other video on derivative market, speculation is a personal right. You cannot blame the instruments for having the speculators coming or something like that. But I think uh, we need to give more, like comprehension, knowledge, and also the uh, proper regulations to make sure that the playing field is right and they do things legally and rightly. Okay, so but we cannot blame the instruments, right? Because again, people could use anything, right? For example, we have the uh, maybe a certain pill, certain medicine for headache, right? Like the Advil, for example, the ibuprofen, Advil. Of course, most people will use Advil for uh, reducing fever or getting rid of headache or something like that. But some people just use Advil for whatever in combination with other substances, and they try to get high using that medicine. So we cannot blame the medicine. Right? This is the problem with the decision maker or the speculator. But why they're doing speculation? Because they have the myopic thought that doing speculation is easy, like it merely chooses red or blue, right? So it seems easy, but again, you see the risk is 50% loss, right? Or at least or minimum 25% loss, and that's very big. So for large banks, trading income may be a major source of income. So uh, they're getting more and more money from this kind of income, right? So traditionally, banks or financial institutions will get the uh, major income from the net interest income, right? The difference between what they charge to clients and what they have to pay to depositors and other creditors, right? So that's the traditional style of doing business. But nowadays, the fee-based income or the trading income has become more and more dominant, right? More and more important. Of course, not yet dominant, but more and more important part of the total income that they are making. For example, they could do this activity, the market making activity. So market making, so you become an intermediary, right? You become an agent of customers who make or to facilitate a certain transaction. However, you see this one, most risk arises from taking open positions in currencies. So taking open positions or naked positions without the underlying situation is very dangerous, right? Because again, if you do the hedging, hedging means you protect the value of something, right? The activity to protect the value of something. Because hedging comes from the word hedge, which means gate. So you try to protect the value of something, right? Your assets or your liabilities or anything. You protect uh, you protect something that you want to protect uh, by reversing the situation. Okay, by reversing the situation. So that we're going to see in the following examples. So mismatches have become common in modern world between assets and liabilities in denominated in foreign currencies. Okay, and ability to raise funds from international sources uh, has been very attractive as well, especially if you can go to other countries with maybe lower interest rate, lower uh, scrutiny or something like that. So you might be able to get cheaper borrowing from somewhere else. That's why you go there. On the other hand, the asset side, for the asset side, is the same. Maybe you can go to new places, right? More exotic markets to earn easier money because the competition is still more lax over there. So you have uh, less competitive environment and you can make more money there. Of course, the uh, higher expected return is usually paired with higher level of risk as usual. Okay, return and risk of foreign investments. First source of return is a spread between the cost and revenues. So again, usually we call it the major and dominant source of income is the net interest income. So it's the difference between uh, like the interest rate or interest revenues that you gain from your clients and the interest payment that you have to disburse to your depositors and other creditors. And then the changes in foreign exchange rates, this one, something beyond your control that you have to manage. Right? Of course, you are merely a price taker, so you are not most of the time you are not a price determiner, right? Unless you're having or you're running business in a more remote country, smaller country where the amount of money that you are having is really huge, such that you could actually affect the market. Right? But in normal countries, you will not be able to determine the prices, right, or to affect the market. So you're simply a price taker. See this one, right? Changes in foreign exchange rates are not under the control of the financial institution, unless you have like plenty of money and you are playing in a smaller country, a smaller market, where that amount of money could affect, could determine even the prices, and even uh, we could say that you could cook, right? You could cook the prices of the financial instruments in that market because of your huge amount of money relative to the size of that market. Okay, so we'll see a situation now. situation where yeah, here's the situation, right? So you have, this is the liabilities that you raised, right? $200 million, okay? And say how much is the interest rate? So you earn, see the story here? Okay, 8%. So the interest charge on your liabilities is 8%, right? And then you try to make money in the domestic market, you'll get 9%, right? Uh, but if you go, here's the point, right? This is very interesting and common situation. You see here, you raise your liabilities in US dollars, right? And it is like 200 million. And your interest charge, your cost of debt is about 8%, right? Let's say the average cost of debt is 8%. So if you make your business here, uh, and for the sake of brevity and simplification, let's say I invest also 200 million. Of course, this situation is impossible for a financial institution, right? Because you need to maintain your capital adequacy ratio. So you cannot lend out all of the 200 million. Maybe you could only lend out like 100, 190 or 180 or something like that. But just for the sake of example, okay, if you lend out all of your financing, right? You lend out the money in your domestic market, in this case in the United States, you will earn 9%. So of course it's still profitable, right? But uh, the spread on the gap is only 1%, if you notice, right? So you have to pay your interest charge of 8%, and you are making 9%. So the difference or the spread is only 1%. That's why uh, in this like globally competitive industry nowadays, you try to make more money by going to another country. So simple question, right? Why do you bother and take the effort to go to other countries to lend out money there, to make business there? The foremost reason is, of course, to make more money somewhere else, right? Maybe you're going to more uh, less competitive countries, less regulated countries, or whatever it is. So in this example, this bank has decided to split its investment, right? So 100 million in the domestic market, where it is expected to gain 9%, right? To enjoy 9% return, and it's going uh, to UK, right? In this example, go to UK for the remaining 100 million. So 100 million, but going to the UK. So we'll find out later how much is it. And you are expected to get 15%. So you see, the spread is really handsome, right? So 15% compared to 9% in the domestic market. That's why you go there. So let's calculate now how much is the spot rate. See the story. Okay, so the spot rate is 160. Okay, 160. Let's calculate now. So $100 million, uh, the spot rate is 160. So do we divide or multiply? See, the currencies are the same in front, right? So you multiply, right? You divide, right? They're the same in front, right? This is dollar per pound, and what we know is $100 million. So we divide, right? Because they're the same in front. The currencies are the same in front. So uh, 100 million divided by 161. So we get 62,180 and 80 cents. 80 cents. Oh, so it's not 161, but 160. Pardon me for that. So this is 160. Sorry, so I have to repeat a bit. 160. So 1 million divided by, sorry, 100 million divided by 160, we get 62 million, 62.5 million. Okay, so 100 million is converted into 62.5 million pounds because the spot rate is $160 per pound. Okay, so now we can estimate, right, what will happen if this is the smooth scenario, good scenario where nothing happens. So let's say 1 year later, the spot rate, right? The spot rate 1 year before was 160 per pound, and 1 year later, uh, the the spot rate remains at $160 per pound. Well, this is good scenario, right? Very smooth and nice. So what will happen to your income and also costs? So let's see the situation, right? So you have your total liabilities is 200 million, right? 200 million. So you have to pay how much? 1 year later, you have to pay 200 million. So you have to pay 200 million times 1 plus then the interest charge 8%, right? So you have to pay 216, right? So 200 is the principal and 16 million is the interest charge or interest expense, right? But with a simple calculation. What about your asset side, your investment? Remember you have 100 million, right? Domestic investment, and this will give you 9%, right? Based on the story, see here again, right? You earn 9% for the domestic investment. So obviously you will get 109 from the domestic investment, right? What about your international investment? In this story, you have was that 62.5 million, and it will give you how much return? 15% return, right? So it will go by 15%. So obviously you will get 71.875 million. Okay, so 71.875 million. Okay, but how much is it in US dollar right now? You see, this is again the smooth scenario where the spot rate 1 year later remains at 160, right? So how much is it? You see, the currencies are the same at the back, right? Right? They're the same at the back, so you multiply them. Right? It's dollar per pound, and you know the pound, so you multiply them. So 71 at 70 at 75 times 160. So this uh, could be translated to $115 million, right? So you see, you 62.5 million pounds was 100 million, right, at the beginning, right? 100 million here, right? So it converted into 62.5 million pounds 1 year, the previous 1 year. So now your money is 150. So obviously, how much return is that? 115 minus 100 divided by 100. So you get what? 15%, right? So this is exactly, you know, the amount of return, right? The level of return that has been expected, right? Because nothing has changed, right? Nothing has changed. Okay, so uh, what about, let's change the situation. Let's imagine that this has changed, right? 1 year later, uh, say the exchange rate has become 150. So think about it. Are you happy with this? So you have 62.5 million investment in the UK, right? 62.5 million investment, and you will earn 15%. So your money 1 year later would be 71 million and 875,000 pounds, right? But 1 year later, you see, so it has changed, right, from 160 per pound to 150 per pound. So are you happy with this? What was happening now? 1 year before, right? Uh, Last year, you could get 1 pound by handing in $160, right? But now, to get 1 pound, you only need to hand in $150. So what is happening now? See, 160 to 150. So the pound has depreciated. The pound has decreased in value. Right? So again, last year, to get 1 pound, you needed to pay $160. Now to get 1 pound, you only need to hand in $150. So pound has depreciated. So are you happy? You have an investment of 62.5 million in pounds, and the pound depreciates in value. Of course, you are not happy, right? You are sad, right? In this context, you are sad. Again, you have an asset in pound, but the pound decrease in value. Of course, you are not happy. So let's calculate. So now you have 71.875 million, right? Because the original 62.5 has grown by 15% as the return, right? So your money is now 71 million something. So how much is it in US dollar with the new exchange rate 1 year later? So you see the currencies are the same at the back, right? Dollar per pound, and you have the pound. So the same at the back, you multiply them. $150. So now in dollar, this is what? 107.8125. Wow. This is not good, right? Because how much return you really get when you uh again you get the money back from the UK, right? You repatriate, we call it repatriation, right? You repatriate the money from the United Kingdom to the US. You could only exchange the 71 million pounds into $107 million. So how much return is it? 107. Let's round it down, okay? 107. So you get around what? 7.8%, right? And you see, your expectation is 15% by investing in the UK. But when you repatriate the money back to the US, actually the return that you really enjoy is only 7.8%. So this is bad news, right? Super bad news. Again, your expectation was 15%, but the reality is 7.8%. So you're losing money not because of your mistake, but simply because of the deterioration of UK pound. Okay, so What about if see another situation? Let's say 1 year later, UK pound has become 165. Okay, so what is happening now for the last 1 year? So last year, to get £1, you had to pay $160, right? But now, to get £1, you have to hand in $165. So pound has increased in value, right? Has been more expensive. So we call it what? Appreciation. So pound has appreciated against the US dollar. And you see the fact here, you have you have an investment of 62.5 million pounds, right, in the UK. So is it good news? Of course, this is good news. So you are happy. In this case, you are happy because now you have an investment in UK pound, and the value of the pound has increased or has appreciated. So let's recalculate now. The new spot rate is 165, uh, and after 1 year, again, we'll have 71 million, right? Because the 62.5 million will go by 15%, right? You will get a return of 15% in the UK. So you have 71.875 million. And again, see, we know the quote here, dollar per pound, and we know the amount of pounds. So they are the same at the back, right? The currencies are the same at the back, right? The UK pound. So we multiply them times 165. You get $118. 118, yeah, 59.59 million. Wow, that when you repatriate the money, the 71 million pounds can be converted to $180 million, right? If you calculate the return in US dollars, 118 minus 100, your beginning money was 100 million, right? Divided by 100. So suddenly your return is actually better than expected, right? Because you, again, when you went to the UK, you expected 15% return, but in reality, when you repatriate the money back to the US, actually you gain 18% because of the appreciation of the British pound, right? Okay, so this could go like either way, right? Because the spot rate could, no, the pound could depreciate, but it could appreciate as well. So nobody knows, right? That's why if you do nothing. Actually, you're speculating, right? Let's suppose that you do nothing, you let it, just let it happen. Just hope for the best. And if you do nothing in this context, that actually you're speculating because you just hope that the pound, also the exchange rate will remain the same, or even the pound would appreciate, such as the third example here, the third scenario. But if the pound, depreciates, that you will lose money from this transaction because you do nothing. Okay, so now we'll talk about the hedging mechanism. Again, I talk more about this in my videos about derivatives, products and markets, forward and futures, and then options and then swaps. But again, today we'll focus on the foreign exchange risk. Right? So we have on balance sheet hedging. This is a natural hedging that we talked about in the earlier section of our discussion today. And off balance sheet off balance sheet hedging is of course using the derivative instruments, right? Derivative products to hedge against the foreign exchange risk. Okay, so let's see. Maybe we'll start from the on balance sheet hedging. On balance sheet hedging means you try to uh, do the natural hedging Okay, do the natural hedging. So we'll draw this again. The on-balance sheet hedging has a principle that we try to match, always try to match, or as best as possible, match your assets and your liabilities. So we know from the story that we have a 200 million total liabilities, right, with 8% cost of debt. And if you want, again, if you want the natural hedging mechanism, then you try to match your liabilities with your assets, right? So as much as possible, you try to uh, also make this, right? So 200 million with 9% return. Okay, so if they perfectly match, like such as this situation, then you don't need to worry about the exchange rate risk, right? Because you raise your liabilities in one currency, and you also lend out the money in the same currency, so they don't suffer from any exchange rate risk. Or the second possibility would be like this, right? Knowing that you will invest $100 million uh, in the domestic market, but you will invest the remaining 100 in the foreign currencies at the spot rate of, let's check again to make sure. Our spot rate was 160, right? 160. So with the spot rate of 160, so 100 million, again, we calculated above, I think. 100 million would be converted to this one, right? 62.5. So 100 divided by 160. So our asset would be 62.5 million. And this would give us 15% return, right? So knowing that we want to invest in uh, this allocation, this kind of allocation, or this kind of portfolio, uh, then you could adjust your liabilities as well. So you try as much as possible to match them. Maybe you can find 100 million, 100 million liabilities that with the cost of debt of 8%. And you try as much as possible to find 62.5 million pounds borrowing, right? Right? With, for example, 11% cost of debt. So you see, you still have, even without calculation, you can see this easily, right? Uh, if you could match the 100 million, you could match this one with $100 million liabilities, then you have a gap, or you have a spread of 1% here from the US dollar portfolio. However, for this one, uh, you see you have 62.5 million assets, and you have 62.5 million liabilities. Of course, again, you are free from the exchange rate risk because you perfectly match the amount of your assets and that of your liabilities with the same currency, and you could safely earn the spread of 4%. So 1% from the US dollar portfolio and 4% spread from the UK pound portfolio. So whatever happens, maybe we can uh, get one scenario. Maybe the spot rate has changed 1 year later. The spot rate has changed to uh, whatever, maybe 155. Right? It has changed to 155 per pound. Okay, so it doesn't matter anymore because you have matched the number. So what will happen from the US dollar transaction, right? You will earn 100 going by 9%, right? And then for the from the cost side, you have to repay 100 million and 8%. Right? So 109, this is 108, right? So we have a spread of 1 million as your profit from the US dollar transaction. What about the British pound, right? The UK pound. So you will earn 62.5 uh, times 15%, right? Going by 15%. And here, so you will have to pay 62.5. The interest charge is 11%, right? For example here. So let's calculate again. So 62.5 times 1.15 is 71. It's 70 at 75. Okay, and this one 62.5 times 1.11. So this would be 69 375. Okay, so what is the gap again? Here's 1 million $1 million, right? And here, how much is it? 71 minus 69. So 2.5 million pounds. Right, this is the profit, right? And what will happen to this one when you return it? When you repatriate the money into uh, the US dollar, you use this one, right? So 2.5 million pounds, and the quote is $155 per pound. So you multiply, right? The currencies are the same at the back, right? The UK pound. So times, so 2.5 million times 155. So this would be 3,875. Okay, so yeah, so you see, right? It's about 4%, right? It's about 4% gap that we could calculate, right? We just estimated. Okay, so uh, we will not find uh, any exchange rates if we exchange rate risk if we could perfectly match the asset sides, assets and liability sides. Okay, so this is called natural hedging or on balance sheet hedging. On balance sheet hedging. So uh, here's the problem, right? In real life, this scenario is we could say hardly possible because you really try to match them perfectly, right? And this is a simple example where we only have like two currencies. We are a US bank, and we only have another portfolio in foreign currency, which is in UK pound. However, in real life, we might have to deal with a lot more currencies, maybe 10 or 20 countries, or even maybe 100 countries, and so forth. So how to match the liabilities in one currency and your assets in that same currency would be surmountable, a surmountable task, something that we could hardly do, right, in modern times. So uh, maybe uh, we can do it as best as possible. We try to match them uh, at the maximum, at the maximum level, but still we have the remaining amount, right? So the remaining amount has to be dealt with or has to be managed using the derivative instruments that we're going to see right now. Okay, so the second type of hedging would be the off balance sheet, right? Off balance sheet hedging. So we are using the derivative transaction. Okay, so derivative transaction, uh, so we can use So let's say we have a contract, okay? So we are coming back to our original situation. So we have 200 million dollars liabilities with 8% cost of debt, and we have 100 million investment with 9% return, and again another 100 million, but in UK pound because the spot rate is 160 at the beginning, right? So 100 divided by 160 is 62.5 million, right, with 15% interest. Okay. So let me. Okay. So the second one is to use the off-balance sheet hedging or the derivative trading, like derivative market trading. So now see your position, right? So you have 62.5 million pounds, right, as your assets. So what will make you happy and what will make you sad? This is very important principle, right? So you have uh, one part of your assets is in UK pound. So you will be happy if the UK pound appreciated, right, or appreciates, right? And you will be sad if UK pound depreciates. Agree, right? So think about it again. You have uh, you have an asset in pound, right, which amounts to 62.5 million, right? 62.5 million pounds. So you will be very happy if UK pound appreciates, but you will be unhappy if the UK pound depreciates, right? It's very natural, very logical, right? So uh, again, if you watch my video on the derivative products and markets, you can see a simple principle here. So you go to the derivative market. We'll give a very easy example today using forward or futures. You just need to take a reverse position of what you're afraid of or what you fear for. Okay, so in this case, what are you afraid of? Again, right? What will make you unhappy is if the pound depreciates, right? So because you have your asset in pound, you will be sad if pound depreciates. So you want to do something so that if pound does depreciate, you earn money from that derivative market. Okay, so see, right? So you are unhappy if pound depreciates. Okay, pound depreciates. Okay, so if pound depreciates, you are unhappy. So you want to do something in the derivative markets so that if pound does depreciate, you earn money from this market, from the forward or futures market. Okay, so you take a position that will give you money if pound does depreciate. Okay, so again in the Forward and futures market, we have long and short position, right? Long means to buy, short means to sell. Okay, buy and sell, right? So um, it's very easy also to determine the position that you should take. So if you come to the derivative market as a hedger, right? Someone who is doing hedging activity, actually you don't need to analyze anything. You just need to determine your interest and your position, right? Your position of interest. So again here, think about it, right? If you are afraid that something valuable in your life will increase in value, something you want will increase in value, then you buy it first, right? If something will increase in value, you buy it first. Uh, but if you foresee that something will decrease in value, you will short it now. You will sell it now so that when the price does go down, you get profit, right? Because you have made a contract to sell it at a higher price. Okay, one more time, right? Uh, if you expect something to increase in value, you buy it first, right? You take a long position, you buy it first. So you want to buy it when the price is still cheap before it goes up. On the other hand, right, if you think that something will decrease in value, you want to short it now. You want to sell it now at a higher price. Okay, so we'll combine this story now. What is it? What are you afraid of? You are afraid of what? Depreciating pound, right? Because you have your asset or part of your assets in UK pound, right? That is 62.5 million pounds. You are afraid of depreciating pound. You are afraid that pound would depreciate, right? So what position should you take? You are afraid of decreasing value of pound. So what position? Absolutely what? Short pound, right? Short pound position is the position that you will take. So you don't analyze anything, right? You don't analyze it. You don't need to use even your sophisticated knowledge or even your hunches or anything like that. The position is determined by your interest, right? What are you afraid of? Again, what are you afraid of here? You have part of your assets in pound. You are afraid that pound would depreciate, right? Or depreciating pound. So you want to do something so that if pound depreciates, you will earn money from there. What position is that? You are afraid of the decreasing value of pound. So you want to short pound, right? You want to sell it, you want to make a commitment to sell it at a higher price right now. Okay, so let's assume that we go to the pound futures market, right? Futures market, and we see that the 1 year futures has this quote 152. Okay, so you go to the futures market, and as I explained in another video, right, in the video on derivative products and markets, if you go to the futures market, you cannot negotiate, right? You can only take it or leave it. If you want to negotiate, you have to go to the forward market. You could negotiate with your counterparty or counterparties, right? With another bank, with another business partner, and so forth, right? But if you go to the futures market, you just take it or leave it, okay? So let's assume that you go to the futures market and you get this quote, right? 1 year pound futures, right? 152 per pound. Again, right? The position that you're going to take is not determined by your analysis, nor is it determined by your hunches, but you simply go there to take a position based on your interest, right? Based on your position of interest. One more time, right? You have UK pound, you have your assets in UK pound, some of them. So you are unhappy. You will be unhappy if UK pound depreciates, right? So because you're afraid of depreciating pound, then you take the short pound position. See the principle again, right? So if you're afraid of a decreasing value of something, then you want to short it first, right? So you take a short position, okay, with this quote. Okay, so let's say, okay, you just take the short pound position at $152 per pound. Okay, so let's see what will happen 1 year later. The spot rate uh, spot rate 1 year later is maybe 150. Right? This is a real spot rate 1 year later at 150. Okay, so what will happen to uh, your big picture here? You have 200 million liabilities, and of course you have to return it plus the interest, right? The cost of debt is 8%, right? Those 208. Oh, sorry, 216. And then you have $100 million, right? That will grow by 9%. So you have 109. Now the remaining 100 million uh, was in UK pound, right? 62.5 million pounds, because the spot rate was 160, right? 160. So 100 million uh, was converted to 62.5 million because the spot rate was 160, right? So 100 million divided by 160 is 62.5 pounds. And the expected return is 15. So you will get, what is it again? 71 something? 71,875. So this would be 71,875, right? 71 million 875. Okay, but now see the problem here, right? The spot rate, right? The spot rate 1 year later is exactly what we feared for, right? What we were afraid of, that the pound has depreciated. Pound has depreciated, right? From 160 to 150, 160 to 150. So last year we could get £1 by paying $160, but this year, right now, to get £1, uh, we need to only pay $150, right? So last year, again, to get £1, we had to hand in $160, but this year, right now, to get £1, we only need to pay $150. So pound has depreciated, or in other words, dollar has appreciated, right? Okay, so this is, of course, you are unhappy, right? Again, you have put your assets in UK pound, but now the value of pound has decreased, right? So you are unhappy, and therefore you suffer a loss here. So how much is it? 71,875, and the new spot rate is what? $150 per pound, you see? So the currencies are the same at the back, right? It's dollar per pound, and this is pound, so they're the same at the back, so you multiply. So 71,875 times 150. So 100, this is $107 million at 125. So you see, when you repatriate the money, your return is not 15%, right? But only 7%, because the money was $100 million. But at the end of the year, when you repatriate the money back from the UK, it has become only 107.8 million. So only 7.8%. This is disappointing, right? So you are losing the let's say, losing the money compared to the expectation, because 1 year, the previous 1 year, you expected to earn what, 115 million, right? Because 15% of 100 million is 15 million. So it's expected that 1 year later, your money would be $115 million when you repatriate it. You repatriate it from the UK. But it turns out that you only get 107.8 million. So this is not good news, right? For your balance sheet. However, remember 1 year late, 1 year before, you you had made this contract, right? You made this futures contract, and you took a short position. Took a short position meaning the selling position, right? And you short. What was your position again? Short pound, right? Why did you take short pound again? Remember, because what you were afraid of was the decreasing value of pound, right? The depreciating pound. So because you're afraid of depreciating pound, you took the short pound position, right? You wanted to sell it first, right? So you made a commitment to sell it first, and the contracted price from last year was 152, right? 152. Okay. So let's assume that uh yeah, to make simple, okay, the futures price, right? Or maybe we don't need to go that far. So what is your contract in the real life? One contract size for futures would be 60 62,500, 62,500 per contract. So maybe you make 1,000 contracts, right? Because your exposure was 62.5 million, right? And one contract for pound futures. The size of the contract is 62,500. Okay, so you obviously you made 1,000 contracts, so you short pound, right? So how much could you sell according to the contract? It's 152 per pound, right? 152 per pound. So let's calculate now how much you could sell. So the futures, 1 year futures rate was 152 per pound, and you short pound, and the size was 1,000 contracts. So you could sell it at how much? You could sell it at so 152, right? So the per size is 62,500 per contract, right? The size of the contract is 62,500 times 1,000 contracts that you made. So this is 62.5 million, right? Exactly the amount that we wanted, right? So you sell 62,000. So you sell 62.5 million, and then how much will you get at 152? So you multiply or you divide? You multiply, right? The currencies are the same at the back, right? The currencies are the same at the back, dollar per pound, and you have the pound here. So you multiply. So the amount that you will get would be 62.5 times 152 is 95. So you will get 95 million dollars, right? So one more time, right? Your contract says that because you took the short pound position, right? So you could sell 1 pound and get $152 dollars, right? And the size of the contract, the size per contract is always 62,500 pounds, and you sold or you shorted, you took a short position of 1,000 contracts. So the the amount of or the size that you uh, shorted was 62.5 million, right? Exactly what the amount that you have. Right? Uh, Sorry, maybe to be more precise, we have to calculate the interest rate as well. But here's the problem with futures. You cannot negotiate the what's that, the size, okay? So if you have the remaining amount that is not really rounded according to the size that we have, how much is it again? 71, right? Because we have the interest rate as well. So 62.5 million is the size that you could do because you took 1,000 contracts. But if you want to include the return, so the total amount that you want to hedge was actually 71.875 million. So you couldn't do it entirely in the futures market, right? Because again, the size is 62,500, and if you took 1,000 short positions, then the exposure that you could hedge would be 62.5 million only. But in fact, you wanted to hedge 71.875 million, right? So maybe let's change the story a bit, okay? So maybe we do it for the forward. Instead of futures, let's do it in the forward market to make the story more simple, okay? Okay, forward. So you would actually you would hedge the whole amount rather than 62.5 million. Okay, so the amount that you would like to short would be 71 million point 875. Okay, so once again, you took a short position, right? Short position, and the quote says that because it's short position, right? You could sell 1 pound, right? You could sell 1 pound by getting $152, right? And the size of your contract, because this is forward contract, so it's free. You could negotiate by yourself. Is 71.87 pounds. So how much dollar will you get 1 year later from this contract? So can you deliver 71.875 million pounds, and then you will get this multiplication, right? It's dollar per pound, and you have the pound here. They're the same at the back. The currencies are the same at the back. So you multiply. So 109, this is what you get. 109 25, okay? So you get 109.25. So if you see it here, right? So it's 107. This is what you will get from your investment, right? 107.8125. But because you made the contract, you get 109.25, right? 109.25. So you could reduce your risk, right? Of course, it's not perfect because this is what you could do, right? Based on the spot position and the forward rate. Okay, so if you do nothing, If you do nothing, then yeah, you suffer more losses, right? Like this one. You see here, the amount of money that you get is only 107, right? 107. But you see, when 1 year later, when you get this amount of money, immediately you deliver it to the forward market, right? Because you had made the contract 1 year before, right? So let me repeat the process, right? So you have you have 62.5 million investment in UK pound that will grow by 15%, right? So you know that next year you will have 71.875 million pounds. This is the amount that you will expect next year. If you do nothing, then you might succumb to again what you are afraid of, which is the decreasing pound value. And you see here, if you do nothing, what you are afraid of does come to pass, right? So the spot rate 1 year later has become 150 per pound. So pound has depreciated, and you see how much you will earn when you repatriate the money back at the new spot rate, right? 150. When you multiply this, you only get 107.8 million. It's far below 115 that you expect, right? Because you expect a 15%, even when you repatriate the money back. But you could reduce the potential risk by going to the forward or futures market. In this example, I changed it to forward market, and the quote 1 year, the previous 1 year, the quote was 152, right? And $152 per pound. And of course, you decided to take the short pound position because that was the position you were afraid of, right? You were afraid of depreciating pound. So you wanted to do something if if pound does depreciate, you would earn money from the forward market. So of course you took the short position, right? Because remember the principle. If you are afraid of a decreasing value of something, you try to sell it first. You take the short position first. Okay, so you took the short position, and the amount of money that you put in the short pound position is this much, right? 71.875, the exact amount that you would get 1 year later. So then 1 year later, once you get the 71.875 million pounds, you deliver it because you have taken a short position, right? You deliver it to the forward market, and you will get, based on the contract that you made last year, you will get 109. So 109, although it's not perfect, you still cannot earn 115 as expected, but still a bit better than 107 that you would have gotten if you did nothing. Okay, so this is called the off-balance sheet hedging, right? So it could improve a bit, right, from what you could have earned, only 107 to 109, because you made the contract last year to sell the pound, right? To sell the 71.875 million pounds that you will get next year. Okay, so I hope it's quite clear for this off-balance sheet. And then we have some parity conditions in multinational finance, right? One of the parity conditions is purchasing power parity. So we have purchasing power parity, we have the interest rate parity, we have the unbiased forward expectation, right? And we have the the uh, international Fisher equation and some other parity conditions. Okay, so how to estimate this? You can do it quickly here. Simple example, right? So according to the purchasing power parity, you have the spot rate right now. right, spot rate right now, and the expected spot rate at the period to come, for example, one year later or 2 years later or anything, this should be a function of 1 plus the inflation rate at home country, right? Divided by 1 plus inflation rate in the foreign country. So what is home country? What is foreign country? So this is important one. To the power of t, right? The time, for example, this is 1 year, so the t is 1, right? So what is home country? Home country is the currency that you mentioned in front. So you always use the direct quotation, right? Home per foreign. So this one, right? The currency that you mentioned in front is the home country, and the currency that you mentioned at the back is the foreign country. So we always use the direct quotation, right? So if you rearrange this one uh, to be right, so now the delta or the change in spot rate divided by the initial spot rate, this could be estimated as again the inflation in home country, right, minus the inflation in a foreign country, right? As we see in this example. So there are two styles here. This is the expected spot rate in the future. This is the initial spot rate, but the one in the bottom is the delta spot rate. So the change in spot rate, right? So we see an example here. Okay, so uh, so Russian inflation is 10%, right? And then the US inflation is 4%. So 4 minus 10, right? So it's minus 4. This should equal this one, the delta, divided by the initial, what is the initial spot rate? Initial spot rate is 117, sorry, 17 cents per rubles. Okay, and how much we get? So we get the delta, delta spot rate would be minus 0.0102. What's the meaning of minus? Minus means no, the what is that? The rubles will depreciate, right? Will depreciate as expected, right? Because the purchasing power parity says that a country with a higher inflation rate will most likely see its currency depreciate. Okay, so one more time, right? So there's uh, purchasing power parity says that a country with a higher inflation rate will most likely see its currency depreciate, right? So here, the inflation rate in Russia is higher than that in the United States, right? So that's why, see, it's minus. Minus means the number is decreasing, meaning that the rubles depreciates, right? From uh, 17 cents per rubles to maybe 15 somethings, right? 15, yeah, 15.98, yeah, something like that. So from 17 cents to 15.98 cents. Okay, we saw this, right? You can see an example, another example here. The interest rate of, sorry, sorry, this is interest rate parity, okay? Just the same, to get more, more understanding about the parity conditions, you can watch my video on the parity conditions session, right? But here we see interest rate parity. So interest rate parity says that a country with a higher interest rate will uh, we're more likely to see its currency depreciate. Okay, so again, one more time, right? A country with a higher interest rate, a higher level of interest rate, we're more likely to see its currency depreciate against another country, right? So here we have the spot rate here, and then the expected spot rate in the future. It should be a function of 1 plus, so nominal interest rate in home country. Again, home country means the currency that you mentioned in front, right, divided by 1 plus interest rate in the foreign country. Of course, to the power of time, right? To the power of time. And if the time is 1, then the t is 1. So let's see an example here. Okay, so interest rate in the US is 8%, and interest rate in the UK is 11%. So you could immediately guess, right, based on the interest rate parity, UK has a higher level of interest rate, so UK pound is more likely to depreciate against the US dollar, and we'll show it, right? We'll prove it. So what is the spot rate? Spot rate is 160. See, so uh, we can write separately here. So the spot rate was 160, right? And then the interest rate in the US is, what is it again? 8%. The home country, because the US dollar is mentioned in front, right? 1 plus 11 in the UK. So what is it? What should it be? Right, so we can calculate. So 108 divided by 111 times 160. So it should be, what should be 155. So the expected spot rate 1 year from now would be 15568. As expected, right? So the expectation says that because uh, the interest rate in the UK is higher, right, 11% higher than 8% in the US, then its currency is likely to depreciate, right, from $160 per pound to 155.68 per pound. Okay. Okay, so here should be like this, right? If you want to use the delta spot, you can do it this way. So delta spot per initial spot should equal uh, interest rate in home country minus interest rate in foreign country divided by 1 plus interest rate in the foreign country. Okay, so what if the real spot rate is not the same as the expected spot rate? Then the arbitrage situation will appear. Okay, so you see, based on the interest rate parity, uh, now the expected spot rate 1 year from now, or even you can implement this to the forward rate as well, right? The forward or futures rate, future for 1 year, for example. Uh, Now, if the real spot rate or the real futures rate real spot rate in the future, or the futures rate doesn't match this calculation, then the arbitrage situation will appear. I will exist, and some people could get the arbitrage profit. And I explained this further in the again my video on parity conditions. But suffice it for now to say that now if the real spot rate in the future, or the futures rate, do not match our estimate based on the interest rate parity, then the like covered arbitrage position will exist, and many traders, right, uh, many players, traders, speculators, hedgers, and everyone would try to cash in, right? We try to cash in from the arbitrage situation, right? The opportunity to gain the arbitrage profit. Arbitrage profit means like easy profit, where you don't even have capital, but you just buy and sell from different places, and you will earn profit. And again, we discuss further in another video. Okay, but see the interest rate parity. Uh, because of the advancement of technology, I think the arbitrage situation is getting more difficult to cash in, right? Because of the technology, right? Once there's an opportunity to get arbitrage profit, then many traders will fight for it, and I think the arbitrage situation will disappear within maybe 5 seconds or 10 seconds, such that only specific people with specific attention could gain from it, from time to time or consistently. Okay, so I think that's all for today. It's quite intensive discussion, and it's overlapping with uh, you know discussion in other videos, of course, from the derivative videos, and also from the parity conditions. But I hope today's discussion could help you gain more understanding on the foreign exchange risk. Okay. Thank you very much, and hope to see you again next time.